Good morning, students. Welcome back to the session on accounting. So we were discussing about consolidation and we'll continue with our discussion on consolidation today. I'll just do a quick recap of various concepts under consolidation that we have discussed. Yeah, and I'm just hoping that you have also revised both the sessions that we have covered. So starting with the consolidation, we understood that every company having a subsidiary is required to prepare consolidated financial statements. And in respect of consolidated financial statements, it's the group which is considered and not the standalone company. So within a group, let's suppose we have a holding company and 3 subsidiaries. So all these 4 entities will be taken together, will be considered as if it's a single economic entity, and then the consolidation will start. Yeah. And in terms of consolidation, means the accounting principles which are required to follow. It was a very simple thing. We just need to do line by line addition of all the items of the subsidiary as well as the parent. Okay. Further, we understood that a subsidiary, whenever gets required, means whenever we acquire any subsidiary, we pay some purchase consideration. And this purchase consideration may be equivalent to the assets that we acquire or maybe less than the amount that we acquire. And in terms of the assets, we are talking about the net assets. So whenever this consideration is in excess, it becomes goodwill. Whenever this is shorter than the amount which has been paid, then it becomes capital. Further, it is not necessary that the subsidiary will be acquired on 100% basis. In many cases, subsidiaries will be partly acquired. Means 60% stake could be there, 70% stake could be there, 75% stake could be there. Now the remaining part means the part which is not held by the controlling part. Means the part which is not held by the majority shareholders. So you can say that part which belongs to the minority shareholders. Means those who are holding that percentage of shares which is not resulting in controlling interest. Yeah, that is called as minority, and that is required to be presented separately in the consolidated balance sheet. And this was again because of the approach of consolidation that we follow, wherein we pick up all the assets, all the liabilities, all the reserves of the subsidiary, irrespective of whether all of those assets, liabilities, reserves belong to the parent or not. And that's why in the CFS, we need to show separately that part which doesn't belong to the parent but still has been consolidated in the consolidated financial statements. Further, for this minority and for this goodwill or capital reserve, we understood that this is not required only at the time of the preparation of the balance sheet. This is required, means this is required to be computed. This is required to be initially recognized whenever this acquisition takes place, which results in the control or which results in getting the control of the subsidiary. Yeah. And this is required to be further remeasured at every reporting year. So that's why in some of the concepts that we covered, every time we were computing the minority interest at the date of acquisition and then we were recomputing it. Or you can say we were remeasuring that. And same goes with the capital goodwill or capital reserve, though there is no change in that because we have not considered any remeasurement adjustments in those. Yeah, we didn't consider that. In relation to minority, there is another thing which the standard requires, and something which we discussed in the last session, that the minority will bear its share of profits as well as losses. Means minority will also be subject to profits or losses. It's not necessary that minority will only get the profits. However, in case the minority keeps getting the losses in terms of its shares, which results in such a situation that the minority is now turning negative. In such a case, minority will be restricted to nil, and any further portion in terms of share of losses of the minority will be passed on to the majority, will be passed on to the parent, and that will continue till the time minority starts getting share of profits. Because the moment the minority starts getting share of profits, that share of profits will also start going to the majority till the time the amount which the majority had borne on behalf of minority is not fully covered up. Clear? Yeah. So these were some of the concepts that we discussed in the previous sessions. Now, before we move further, we can just pick up one more illustration just to revise all of these concepts that we have discussed. In a way, we'll be only the practical. We will only be only be working on all of these concepts that we have covered so far. Plus, there could be one or two small adjustments which could be related to bonus shares, or which could be related to some other adjustments which we will discuss along with the question that we are going to cover now. Okay. So we can move on to illustration number 6 now on page number 10.29. Most of the things over here will remain same except for a couple of adjustments. So all of those adjustments we'll discuss in the solution itself. So you can all move on to illustration number 6. On 31st March 2000X1, P Limited acquired 1,05,000 shares of Q for 12 lakh. Okay. So now this is the situation on 31st of March when Q has been acquired, and on this particular date position of Q is also given to us. Means its PP, its current assets, its equity share capital, pre-incorporation profits. Do you remember the pre-incorporation profits and the post-incorporation profits? Sorry, these are pre-incorporation. These are not pre-acquisition. So its pre-incorporation profits are given, profit and loss balance is given, trade payables. So because anyways, any of the profit which the subsidiary would have earned when this was acquired will be pre-acquisition. Moving further, P and Q give the following information on 31st March X3. Means after 2 years, their position is also given. So if we could draw a chart, we can say on 31st March 2000X1. On 31st March 2000X1, P Limited acquired 1,05,000 shares for Q. So P acquired Q. And on this particular date, some information is available. Then we have also been given information of both these companies of 2 years later. So that means 31st March 2003. So the financial information on this date is also made available. Equity shares of both these entities before bonus issue, securities premium issue, pre-incorporation profits of the subsidiary, that means Q, continues. It was 30,000, it remains 30,000. Yeah. But if you look at the capital, that is also unchanged. General reserve, those seems to have come. P&L balance, that seems to have changed. Trade payables, those have also changed. PP has also changed. I am talking about Q Limited because all the numbers as on 31st March X3 which are available to us, I am just comparing them with the numbers which were available in respect of Q as on 31st March X1. Okay. Investments. Now this is for P, of course, and current assets. Current assets have also changed. Yeah, definitely over a period of 2 years, data of Q had to change. But share capital and its pre-incorporation profits are intact. Directors of Q Limited made a bonus issue on 31st March X3 in the ratio of 1 equity share of ₹10 each fully paid for every 2 equity shares held on that day. Means on 31st March X3, Q Limited has issued bonus shares. On this day, Q Limited has issued bonus shares. So there is a bonus issue. There's a bonus issue on this particular day. And this bonus issue which has come is in the ratio of 1:2. Means for every 2 shares held, 1 bonus share is given. Bonus shares were issued out of post-acquisition profits by using general reserve. So bonus issue has been given in the ratio of 1:2. And we are also given information that this bonus issue has been given out of post-acquisition profits. Okay. And general reserve we are given is 19,05,000. Now you are required to calculate as on 31st March X3, means on this date you are required to calculate cost of control or capital reserve, minority interest, consolidated P&L in each of the following cases. Consolidated P&L means the balance in the consolidated financial statements. Means this will not only include the balance of subsidiary, this will also include the balance of holding. Yeah, so for both, you need to compute these balances. Correct? Yeah. So these are the amounts you are required to compute. And there are 2 scenarios you need to consider. Before the issue of bonus shares, immediately after issue of bonus shares. Means we need to just check whether this bonus issue will have any impact on these 3 things or not. So what are these 3 things? Cost of control or capitalism, cost of control or capitalism, minority interest, and consolidated P&L. These 3 things are required to be computed. And for these 3 things, very simply we need to check whether they will be impacted by this bonus issue or not. If they will be impacted by the bonus issue, we need to recompute. Yeah, as simple as that. Okay. Before we proceed on this, and I would suggest you can just start computing this on your own. But before you proceed on this, there's one thing which you need to remember. Yeah, you remember? Can any of you let me know what is it that you need to remember over here? Please, if you can just let me know. What is it that you need to remember? Yes, that's correct. So now, even though the question is asking us to compute all of these balances on this particular date, can we compute them without computing these balances as on the date of acquisition? Why? Because that is going to be the starting point. That is going to be the opening balance for these amounts. Yeah, so this is the date of acquisition. So on the date of of acquisition, we have to compute all of these balances. Only then we will be able to check what are their amounts as at the year end. Okay, in this particular case, as at 31st March X3. Correct? Yeah. Okay, so with this, you can just start computing all of these amounts one by one. I am also computing it, but I would suggest you can solve it on your own and start sharing your answers. Yes, quickly, you can just start solving it on your own. Okay, yeah. I think first of all, we need to assess the shareholding pattern. So that's the first thing we need to check. Yeah. So now for this Q, what do we see? Q has equity shares 1,50,000, out of which 1,05,000 were acquired by P. Correct? Yeah. So if we look at the shareholding pattern, for shareholding pattern, what do we see? P Limited purchased on 31st March X1, number of shares were 1,05,000. These were the shares which P Limited purchased. And bonus issue is in the ratio of 1:2. Now P must be holding these many shares, correct? Now for every share, for every 2 shares, 1 share will be issued to P. So the bonus issue for P will be 1,05,000 divided by. So these are the number of shares for P. Okay. These are the number of shares for P. Now, if we need to compute the percentage shareholding, let's start computing this. Now, because of this bonus issue, can we say that the shareholding of P will change? Can any of you let me know? The answer is no. Why? Because the number of shares which are going through bonus issue is in the same proportion. Correct? So, few had 1,50,000 shares, out of which P was holding 1,05,000. So, what was the percentage shareholding? 70%. Correct? Now, after the bonus issue, what is the number of shares which are held by P? This will be 52,500. This will be 52,500 plus 1,05,000. So this becomes 1,57,500. Okay, but capital of Q will also change now, because Q will also get 50% more shares. Okay, yeah. So now 1,57,500 as a proportion of 2,25,000. What do you get? 70%. 70% is the number of shares that you get here. Why? Because it's the same proportion. There again, the bonus issue will be 75,000, and this will result in number of shares will be 25,000. So this percentage remains same. Correct? Yeah. So this percentage remains same. This has not changed. Okay. I think Anandraman has computed the goodwill. Very good. Okay, so now as a next step, what do we need? I think the first thing that we can do is we can compute all of these amounts. We We can compute all of these amounts before the bonus issue. And then we'll make the adjustment for bonus issue. Yeah, okay. So now you can say that this is the working capital number 1. So share of P is 70%. Minority interest therefore will be 30%. Minority interest. Over here it was 30%. Over here again it is 30%. So minority interest has remained same. Now we will get on to the calculation before the issue of bonus. So part number 8, before bonus issue. Before bonus issue, let's see what is the adjustment. First of all, if you see P has paid 12 lakh. If you look at the information, it says P paid 12 lakh. So purchase consideration was 12 lakh. Purchase consideration was 12 lakh. Okay. From this, what do you reduce? From this, we will reduce net assets. We will reduce net assets. Yes or no? Correct. Okay. Now, in terms of the net assets, what do we have? Anantraman, I think, has already computed this. Anantraman, you can also share your working. That will be helpful. Huh? Yeah. Okay. So now, in terms of the net assets, let's compute the amount of net assets. $10,50,000. Because we have also got some current assets, some pre-incorporation profits are there, and trade payables. Yeah, but we are computing it straight away as on 31st March X3. Yeah, so that's why we need to check as to what this amount will become. So now, as on 31st March X3, if you look at this amount, as on 31st March X3, what do you see? Okay, we need to check this out. As on 31st March X3, what is the total amount? In terms of reserves, we can say the reserves are equivalent to 19,05,000 and P&L balance is 4,20,000. Correct? Yeah. Okay. Now picking it up, we also need to make an adjustment over here. The adjustment will be in respect of capital profits. So let's get on to that adjustment. Yeah. We need to analyze the profits of Q Limited. So can we get on to this working first of all? Yeah. So I'll just keep this on hold for some time. I'll take you to that working mode. Now, if you look at the profits of Q Limited, on 31st March X1, profits were 60,000. Profits means the reserve balance was 60,000, and there was also a reserve of 30,000. So all in all, 90,000 was the reserve amount, and this reserve was pre-acquisition. This was pre-acquisition reserve, correct? So we can put down the amount of pre-acquisition profits. Pre-acquisition profits, or as the study says, capital profits. Both are one and the same thing. Yeah. So one is pre-incorporation profits, 30,000, and second was P&L balance. Both of these amounts are as on 31st March X1. This is also 31st March X1. Okay, so this is 65. So this gives us 90. Yeah. Okay. Then general reserve. Now we are moving on to 31st March X3. Now general reserve 19,05,000. General reserve 19,05,000. This is post acquisition. This is post acquisition, or we can say revenue profits. Right? So this is post acquisition or revenue profits. Okay. Now, the question further says that bonus issue was made out of general reserve. So that means this reserve will also change in terms of what was it balanced prior to bonus issue, what was its balance after the bonus issue. So we can further bifurcate the revenue profits. Why? Because bonus issue has been paid out of revenue profits. Before bonus issue, or after bonus issue. There are two stages over here. So after bonus issue, what will happen? The number of shares which would have been issued, the share capital which would have been gone out. This needs to be picked up from reserves. So 75,000 were the shares at 10 rupees each. So 7,50,000. Okay. I think Nakul has a problem. Nakul, if you can just go to the study material, please. Go and access it online and you will get this. And I have specified this illustration number 6. So now the balance of general reserve will become 11,55,000. 11,55,000. You can access this online, please. Okay. Now, the next thing. We have another P&L balance of 4,20,000. So now we have a P&L balance 4,20,000. Now out of this 4,20,000, we have already considered 60,000 over here. So 60,000 we have already taken to pre-acquisition. So that means 420 less 60,000 will be post-acquisition. So what is the amount post-acquisition? 420 less 60. So this will be 360. 3,60,000. And how do you get this? 4,20,000 less 60. Why? Because 60,000 we have already considered over here. And 420 less pre-acquisition profit will become post-acquisition profit. Now, does this balance change after the bonus issue? No. So before bonus issue and after bonus issue, this balance will be the same. Now, all in all, what is the total reserve or what is the total balance of profits that we have? Yeah. What's the total balance that we have? It will be 22,65,000 over here. I think that you are referring to the old study material. I would suggest that please refer to the new study material. Yeah, because I can see similar query from Nambada. If you can refer to new study material, please. You can just go download this from the website only. And after bonus issue, what is the amount of reserves? 15,50,000. 15,50,000. Okay, that means 1155 plus 360, and this is 19,05,000 plus 360. Yeah, so that is how the reserves stand. And this is 90,000. So now we have computed the reserves, pre-acquisition and post-acquisition. Post-acquisition reserves have been further bifurcated into before bonus issue and after bonus issue. Okay. Now what do we need? We just need to bifurcate them into two parts. Very simple. Into the share of the majority and share of the minority. That's a simple thing. Yeah. I think Sakshi has also computed these amounts. Very good. And if any of you, I think if Anandraman, if you can share the working of goodwill, please. Yeah, because you have computed this, so you can share the working of goodwill quickly. Okay, so now I'm just simply bifurcating all of these amounts. Start sharing your workings of goodwill quickly. Okay, so now share of P. Share of P means 70% of 90,000. 63. And share of Q. 30% of 90,000. 27. Okay. Similarly, 70% of this reserve. What was the balance over here? What was the balance over here? 15,85,000. This is 70%. Sorry, 85,500. So this is 22,65,000 into 70%. Okay. And 22,65,000 into 30% will be the minority share. 6,79,500. Similarly, after bonus issue share needs to be computed. So this will be 10,60,500. Which is 70% of 15,15,000. And 4,54,500. Okay, I think Sakshi has also computed the amount of goodwill. Very good. Yeah, Sakshi, you can also share your workings quickly. If you have any questions, any doubts in this adjustment or in this computation that we have done, please let me know. Before I move further, yeah, if you have any doubts, any questions in relation to this, please let me know. Another one is saying he directly found this goodwill. Very good. And that is how you need to compute this also. Tell me, any questions, any doubts? In case you have on this, please let me know. Okay, Anushka needs to have shared all the numbers. Okay, Anushka has also computed all of these amounts. Very good. Very good. Okay, so we'll move further on this. Yeah. Okay, so let's go back to this computation that we started with, because in between we have to come to this working mode. So we can give this reference to working mode now. So purchase consideration was 12 lakh. Yeah. And what do we need to reduce? Net assets. So now we'll reduce the amount of net assets. Less net assets. Or in simple terms, what can we do? Less the proportionate share capital and the proportionate reserves. Pre-acquisition, of course. Equity share capital 70%. So what is the equity share capital? 70%. 10,50,000. Okay, and the proportionate reserves prior to acquisition, we have already computed that in the working note. That pre-acquisition share of profits of P Limited in Q Limited was 63,000. Capital profits, or you can say pre-acquisition profits. You can give the reference of working note. This was 63,000. So now, does it result in a goodwill or a capital reserve? I think this results in goodwill. I think Aditya, again, you are doing the same thing. You are referring to the old study material. I would suggest all of you to refer to new study material, please. In case you don't have access to that right now, just go to the website of ICAI. Yeah, on the board of studies, you will get this study material. Pick up the latest one. There you will find it. Yeah, I'm repeating one point. Please refer to the latest study material. So we get cost of control equivalent to 87,000. Now please remember, we understand that 87,000 is the amount of goodwill. Correct? In the question, you have been asked to compute cost of control or goodwill reserve. So that's why the terminology which has been assigned to goodwill by the question is cost of control. You should also use the same terminology. Even if you want to call it as goodwill, just mention it over here as cost of control. Maybe in brackets you can put goodwill also if you want, but that is not required. Yeah. So whatever the question requires in terminology, you should also be using the same terminology. Okay. Clear? Sakshi has computed this. Anushka is getting capital reserve. No, I think you need to revisit Anushka. It's goodwill. It's not capital reserve. Yeah. Correct. Okay, now the next thing for us will be what? Minority interest computation. Minority interest computation. So for minority interest, again will become the same thing, proportionate, capital, etc. So proportionate capital for minority will be the remaining 30%. So that becomes 4 lakh. Correct? 4 lakh 50,000. Yeah. Okay. Then the proportionate share of pre-acquisition profits minority will have to compute. This we have already computed. So this is 37,000. Swati, I'll come back to your query in some time, but I think you can definitely use that. But I'll confirm on your query in some time. For the time being, I don't see this to be a problem if you use this new material. Yeah, at least in terms of this illustration we have been discussing, you should use this. Okay, next is about the post-acquisition profits. Now for the minority, we are doing this computation not only on the date of acquisition. If we are limited to date of acquisition, this will be the amount of minority. That means this plus this. But minority's amount will change. Why? Because year on year, its profit share will keep getting added. So the profit share of minority before bonus issue is what? 6,79,500. Post-acquisition profits. 6,79,500 is the share of minority. So this becomes 11,56,500. Manish and Anushka have also computed 11,56,500. Okay. Clear? Now, the next thing is to compute the amount of profit which will go to P&L in the consolidated financial statements. So moving on to that amount. Consolidated P&L account. Consolidated P&L account. Means in the books of CFS, who will prepare? P Limited. So these are not the books of P. These are books of P and Q. Okay, but this is prepared by P. So you can say, instead of P Limited, we can say CFS. Okay, we can say CFS. So the balance with which they start, is it given in the question? The balance with which they start. Yes. So if you look at the balance, yes. For P, the consolidated P&L balance. So P&L balance of P, 15,75,000. This will be picked up 100%. This is the balance of P. Then what do we add? We will add the share of profits of Q, majority share. Add P share of post acquisition profits. This is again we have computed already 15,85,500. Yeah, so we can take the reference of working. So get 31,60,500. Okay. 31,60,500 is what we get. Clear? Yeah. So all of these amounts we have now computed prior to issue of bonds. Now, can you compute all of these amounts quickly after the bonus issue? Means you just need to incorporate the impact of bonus issue. And that is again, we have already computed in the working note. You just need to incorporate these figures. Yeah, quickly, can you do this? Yes, start doing this and start sharing your answers. I think Sakshi has computed this one only. Okay, great. So now I am also moving on to this B part, means after bonus issue. I'll start with consolidated P&L balance first of all. After bonus issue, this balance of P will remain same, though the share of profits of Q has changed. Instead of 1585, this is 10,60,500. Correct. So now, because of which this would become 26,35,500. Yeah. Okay. Now, moving on to the next part. Cost of control or capitalism. Here again, what do we start with? Here again, what do we start with? Face value of investments. So face value of investments will be what? Now this will change. Or you can say the equity share capital will change. Yes? So we can say purchase consideration. This continues to be 12 lakh. Less equity share capital. Earlier the equity share capital was 15 lakh. Now instead of 15 lakh, this is 22 lakh 50,000. 22 lakh 50,000. Why? Because 50% shares have come and we will pick up 70% of the same. 15 lakh plus 7 lakh 50,000. What is this 7 lakh 50,000? Bonus issue. Okay. And we will pick up 70% of this. We will pick up 70% of this. So what does it become? 15,75,000. 15,75,000. All right. I think Sakshi and Anushka have already computed this. Very good. And the next thing will be the pre-acquisition profits. Those have not got changed. Less pre-acquisition profits. which we computed in the working note, that has remained 63,000. So now, if you see, what do you get over here? Do you get goodwill or the capital reserve? Yes, quickly. Do you get goodwill or capital reserve? I think Anushka is getting goodwill, Sakshi is getting capital reserve. So please check whether this amount will be negative or positive. Very simply, I told you, pick up the purchase consideration first of all and then pick up the net assets. If the amount is negative, what would it become? Capital reserve. And is this going to be negative? Yes. So that's why 4,38,000, which is the correct answer, by both of you, means by Sakshi as well as Anushka. But the only thing is, one of you have mentioned this as goodwill, which is not right. It is capital reserve. Why are we calling it as capital reserve? Because this is negative. Clear? Clear on this? So in the exam, please try to avoid this, because the moment you write that this is cost of control, this will be incorrect. Okay. Clear on this? Moving further. Aditya, as I told you, I'll clarify on this point. Okay, whether the old syllabus students need to refer to this new study material or not. But as of now, for the time being, for this illustration, you need to refer that. Please. Okay, now the last part was about minority interest. So we'll come to the minority interest also. Minority interest. So now equity share capital. Instead of 70%, this will become 30%. So this is 6,75,000. Yeah. Pre-acquisition profits, those are same 27,000. Post-acquisition profits, those have already been computed by us. The working post-acquisition profits are 4,54,500. So all in all, what does it become? 11,56,500. Okay, 11,56,500 is the amount that you get away. Yeah. I think Sakshi is getting the same answer. Great. So now in this example, most of the concepts, in fact, all the concepts that we have discussed are same. There was no change in any of those concepts. So idea was to just recap of whatever we have covered, because there was a break in between. But the only thing which had changed in this example was the bonus issue. Yeah. For your purposes in the examination, just to save time, what you can also do is you can make it columnar. Currently, if you see, we have computed all of these three one by one. Means, first of all, we computed the amounts which were prior to bonus issue, then the amounts which were after bonus issue. Instead of this, what you can also do is you can compute minority interest and you can say this is after bonus issue. and you can also put down one column over it before consolidation. So within one table, you will be able to compute both. So you will not have to write all these points one by one. Yeah. So if you want to save time, you can also follow that. Clear? Okay, Manish has also computed this. He's getting the same answer. Very good. If there's any question, any doubt, please let me know before I move further. Clear? Any questions, any doubts in case you have on this? All right, so let's move further. Nishma, we can go back to your query, maybe towards the end of the session, please. But please remind me towards the end of the session. Okay, so now, moving further, on to preparation of balance sheet. So now we have done all the adjustments which were required for preparation of consolidated financial statements. Now, all the adjustments have been done once. Whether it comes to minority, whether it comes to goodwill, capital reserve, whether it is about some of the eliminations, etc. We have understood that. Yeah, every adjustments we have covered, we have discussed. But what was the ultimate objective for us? Ultimate objective for us was preparation of consolidated financial statements, which is something we have not done. We know how is that required to be done, but we have not done that so far. So now we will be starting with the preparation of consolidated financial statements. Okay. For CFS, we have already discussed. I'm just quickly revising this point that whenever we prepare the CFS, we will do line by line addition. Means if this is the holding company, this is the subsidiary company, all of its assets, all of its liabilities, all of its items of P&L, means each and every line item will be added together. So we'll get total. Correct? This is called as line by line addition. And then we make some adjustments. Now these adjustments could be for minority interest, because that will not appear in their balance sheets. In standalone balance sheets, minority interest will not come. So we'll have to put it over here. In standalone balance sheets, in standalone financial statements, goodwill will not appear. We'll have to put it over here. In standalone financial statements, they may have intercompany transactions. We'll have to eliminate that. Remember, we talked about elimination. We'll have to eliminate that. Yeah. So all of those adjustments will have to be passed. And then we get the CFS, or you can say consolidated balance sheet, or the consolidated P&L, or the consolidated cash flow statement, whatever the case which is required to be completed. Yeah, clear? Okay. Now, for this, what we can do is we can start with a very simple example. Okay, very simple illustration, wherein we'll do this line by line addition. Okay, I'm starting with a very simple illustration. Illustration number 7 on page number 10.33. Yeah. Question requires you to prepare consolidated balance sheet of H Limited and its subsidiary S Limited as on 31st March X1 from the following information. Means on 31st March X1, balance sheets of two companies are given. One is holding and second is subsidiary. You are required to prepare consolidated balance sheet. See, the question doesn't require you to prepare consolidated financial statements. Please remember, balance sheet and financial statements are two different terms. Financial statement comprises of balance sheet and various other components. Okay. Mostly, you will not be required to prepare a complete set of financial statements. Yeah, mostly you will not be required to prepare because then it becomes very lengthy. But anyways, we all understand about it as to how to prepare this. So we can definitely do that if required. Yes or no? Okay, so now moving further on to this. We have been given one information that H Limited acquired shares of S on 31st March X1. Now this will be helpful. Why? Because this information will let us know, or this information will help us to understand about the amount of pre-acquisition and the post-acquisition. Yeah. So if we understand that the acquisition has taken place on 31st March X1, so this becomes everything prior to this becomes pre-acquisition. Yeah. Means all the reserves that we see over here are pre-acquisition. Okay. Now, what is the first thing we need to compute? First thing will be to understand if there is any minority in this. So if you look at S Limited has got S Limited has got 25,000 shares. Sorry, 2,500 shares. S Limited has got no. So it's 25,000. Okay. Out of which out of which 20,000 are held by H. Yeah, 20,000 are held by H. So that means percentage shareholding of H means the holding company is what? 80%. Yeah. So let's get on to this computation. I think these are fully paid up shares of ₹100 each and not ₹10 each. Yes, we can make this small correction on this. These are fully paid shares of ₹100 each, and that's why the number of shares is 2,000. And this is not really 20,000. Yeah. Either way, you can change it. Okay. percentage shareholding. Total shares of S 25, out of which H holds 2000. Percentage held by H 80%. So minority interest is 30%. This means we have minority interest in this question as well. Yeah, so when we prepare the balance sheet, minority interest has to appear. How does it appear? We'll have to see that. We'll have to make the adjustments for its computation. Okay. Next will be to compute the amount of goodwill or capital reserve. Because that is not available in the question. We will have to compute that. Yeah, we'll have to compute that. So we can move on to the next working notes. We can say this is working note number 1. Working note number 2. As we discussed, we can say calculation of goodwill or capital reserve. For the time being, we can just simply say calculation of goodwill or capital reserve. Yeah. So now, purchase consideration do we have in this? Yes. The amount which is invested by H is entirely in S. So this must be the purchase consideration. Correct? So we can say cost of investment is nothing but the purchase consideration. This was 2,20,000. Now from this, what do we reduce? Net assets. So do we have equity share capital of S? Yes, it's 2,20,000 less net assets. So equity share capital 80%. So 2,50,000 into 80% becomes 2 lakh. And we need to consider pre-acquisition profits. So all the reserves which are given in the balance sheet of S are pre-acquisition. 1 lakh. So pre-acquisition profits 80% into 1 lakh. So this is 80. So now this number again will be positive or negative. Please check it whether this number will become positive or negative. Quickly, are you getting a goodwill or a capital reserve? Can all of you confirm this? Because I saw there was some confusion on this point. That's why it's important for all of you to let me know whether we are getting a goodwill or a capital reserve. Yes, I'm waiting for a response. Are we getting goodwill or capital reserve over here? Tell me quickly. Huh? Okay, great. Anushka is saying yes, it's negative. So what does it become? Goodwill or capital reserve? Sakshi has given the answer. I'm waiting for all of you to confirm. She is saying it's goodwill. Why would it become goodwill? Because I can still see this same confusion. Nishma, Sanjay, and Sakshi, they are saying capital reserve. Very good. Kushi, you need to remember that moment we say it's negative, what does it become? It becomes negative goodwill. And what is negative goodwill? Capital reserve. Okay. I knew this confusion still continues. So that's why it's very, very important for you to understand what is goodwill or what is capital reserve. So this is capital reserve. All right. Clear on this? Okay, Manish is also saying it's capital reserve. Anushka and Sushil are also saying it's capital reserve. Very good. So now we will move on to the preparation of balance sheet. Now, whenever we are required to prepare the balance sheet, you always need to remember that we need to follow the format of Schedule 3 always, irrespective of whether it's given in the question or not. Whenever you will give the solution, you will have to strictly follow the format as per Schedule 3 only. So that means, along with the balance sheet, along with the P&L, wherever required, you will prepare the notes to account. So it has to be a proper balance sheet as per Schedule 3 format only. Yeah, clear? Okay. So now, in this case, we will move on to the balance sheet, and we'll also keep some space for the notes to account. You can also start preparing the balance sheet. You can also start preparing the balance sheet. Yeah, start preparing the balance sheet. As we have discussed, it's line by line addition only. And in this case, a couple of adjustments which are required, we have largely done that. Okay, so can you start preparing the balance sheet? So we'll write consolidated balance sheet of the group. Group means of H Limited and its subsidiary S Limited as at 21st March X1. Okay. Yeah. So that amount, and for the amount, we also need the note reference. And I'll keep some space for the notes. So we have equity and liabilities. And over here we have got shareholders' funds. And for the shareholders' funds, we will get share capital, means the equity share capital, and the reserves and surplus. So for this, we can get reference of that. Then we prepare minority interest. Note number 3. Now all of these information I am picking up from the balance sheet given in the question, and accordingly I am deciding the captions. Next thing is trade payables. So trade payables should be a current liability. So trade payables. So I am giving more reference for trade. Okay, and then we have assets. For assets, we'll start with PPE, non-current assets. You should not use abbreviations, please. I'm doing this, but please don't use abbreviations. PPE, this is note number 5. And then we have current assets. Question also gives you current assets. So current assets you have this current assets. So this is note number 6. have very little space available for nodes. So what I can do is I can also erase some part of this if required for the purpose of nodes. So what I'll do is I'll just pick up the small items first of all. Trade payable. You should have your nodes in the order always. So in the solution, first of all, your node number 1 should come, then node number 2 should come, then node number 3. If you believe that the information for node number 1 is not fully available, you can just prepare it and give some space. But this has to be in order. You can't have your node number 9, then your node number 6, then your node number 3, then your node number 1. No. Nodes have to be in order. Always in the solution. Yeah. But for the time being, I'm not doing this again. I'm just writing node number 4 first of all. But as I told you, don't do that. This is because of the space constraint I have to do this. Trade payable. Node number 4 is trade payable. Now, so for trade payable, do we have any adjustment? No. So we need to just simply add the balances of H and S. 175,000 and 50,000. H limited, S 1,75,000 and 50,000. So this becomes 2,25,000. So we can just straight away take this amount over here. 2,20,000. Correct? Then for PPE, do we have any adjustment? No. So this will also be simple addition, 5 lakh and 3 lakh. This is node number 5. This is 5 lakh and this is 3 lakhs. This becomes 8 lakhs. 8 lakh I have put over here. Okay. For current assets, do we have any adjustment? No. This is again very simple one without any adjustments. So 155 and 1 lakh. And 1 lakh. So this is 2,55,000. Yeah. So this becomes 2,55,000. Our asset side is completed, but still we'll take the total at the end. Okay. Now we are still left with 3 nodes. Yes, let's go to node number 1. Let me just compute this node number 3 first one. Minority interest. Now for minority interest, what we need? Share capital of S on a proportionate basis. So 2,50,000 into 20%. $250,000 into 20%. So this is 50,000. Then the share of profits, 1 lakh into 20%. So this is 70,000. So minority interest is 70,000. Okay. Then We'll move on to note number 1, share capital. Share capital of H Limited is 5 lakh. So 50,000 equity shares of rupees 10 each. 5 lakh is the equity share capital of H. Now let's look at the capital of S. Do we need to add it over here? No. Why? Because that is already distributed amongst minority. Minority has already picked up its share of capital. Number 2, share of majority has also been picked up while computing goodwill or capitalism. So it's not there anymore. And anyways, this capital of S will get knocked off with the investment of H. So that's why you don't see any investment over here. Can you see any line item for investment? No. Clear? So that's why this capital will be limited to 5 lakh in the series. So this is 5 lakh in the series. Clear? Okay. Next will be the reserves. This was note number 1. Now we move on to note number 2, reserves and services. Now we have P&L balance of H Limited. Now, as regards the P&L balance of S, can we pick it up over here? No. Why? Because part of that P&L balance of S has already gone to MI. And the other part has already gone to whom? That has already gone to goodwill or capital reserve. There is nothing which is left. There is nothing which is left. Correct? I am repeating my point. Part of that reserve balance is gone to minority interest. Means 20% is gone to minority interest and 80% is gone to goodwill or capital reserve. So that's why it's 0. But a reserve has been generated. While computing goodwill or capital reserve, we got capital reserve. So where will it appear? That will appear over here. And because it's a capital reserve, so that's why we will put it first. We will not say P&L balance first. No. You will put capital reserve first, which comes from the working note number 2, and I think the amount was 60,000. So this becomes 2,60,000. Now you can take the totals of balance sheet and P&L and confirm whether they are matching or not quickly. Just quickly, you can give me the total of balance sheet. Anushka is saying total of asset side or liability side. Both the sides. Okay, for Anushka it is matching. Let us check for others also whether it is matching or not. I think all of you are picking up this slightly later. Rajeshwari has the same query that says my study material doesn't match with the one you are currently taking up. As I told you, you need to pick up the latest study material. Okay. Okay, so she's saying both the sides are matching and we are getting a total of 10,55,000. Okay, so this is 10,55,000 and this is again 10,55,000. Very good. Nishma is also getting the same answer. I think Namrata has a query. Namrata is saying, sir, please pick note number 1. Note number 1 is very simple. That is about equity share capital. Now, in the equity share capital, if you go to that note, we picked up the equity share capital of H. That is 5 lakh. But we didn't add the share capital of S. Why? Because this gets knocked off with the investment of H in S. Clear? Clear on this? Clear on this part? So this share capital of S will not appear in the consolidated financial statements. That has been knocked off. That is gone. Yeah, clear Namrata on this? Lakul is getting the same answer. Very good. Manish is also getting the same answer. Great. As I told you, this was a very simple illustration and the idea was to just get onto the approach. Okay? Just to get a feeler as to how this balance sheet is required to be picked up. Alright, so now you have understood the principles of consolidation and we have also applied that in a very simple manner. But we'll also pick up some more illustrations wherein we'll prepare the balance sheet only and we'll understand as to how all of these adjustments are required to be done, be it minority, be it share of reserves in the consolidated financial statements or be it goodwill or capital. Okay. Yes. So before we move further, if you have any doubts, any questions, please let me know. And I think we'll not move further. Yeah. After discussing your queries, we'll take a break, and after the break, we'll continue with some more discussions. Yes. Over to you. If you have any doubts, any questions on this, please let me know. Yes, quickly, I'm waiting for your queries. Any doubts? You're all clear on this? Understood about the balance sheet or the P&L? Manish is saying, sir, how do we show investments in the balance sheet? See, if this is the investment in the subsidiary only, that has been knocked off. Why? Because please understand, this is H and this is S. So what are we doing? We are adding each and every line item. So H had investment and this investment of H was appearing in the balance sheet of S as share capital. So you can say it's a transaction between these two companies. So let's suppose this is 100 and this is also 100. So what do? We knocked off any transaction between these two companies will be knocked off. Same goes with this principle also. So if the investment is in the subsidiary, that will not appear in consolidated balance sheet. But if that investment is outside the subsidiary or outside the group, that will definitely appear. Okay. Nishma is clear on this now. I'm hoping Manish, you are clear on this. Manish has also understood. So we can now take a break. Yeah, after the break, we'll continue with some more instructions. Let's take a break. Hi, welcome back. So we'll now continue that discussion. So we can pick up another illustration wherein again we'll prepare the balance sheet only. Okay. And after preparing the balance sheet, we'll pick up the illustrations for P&L, then we'll pick up the illustrations for cash flow. Okay. So that is how we'll move forward. So we can all move on to illustration number 9. This is page number 10.37. Illustration number 9, page 10.37. Yeah. From the balance sheets and the information given below, you are required to prepare from the balance sheets and the information given below, prepare the consolidated balance sheet of Virat Limited and Anushka Limited as at 31st March. Means this is 31st March X1. Virat holds 80% equity shares of Anushka since the incorporation of Anushka. So we have V Limited, A Limited. So V Limited holds 80% shares of A Limited. And V Limited has been holding these shares since its incorporation. So which means we don't have any pre-acquisition adjustment in this case. Correct? Now, balance sheets of both the companies are given. So you can see the balance sheet is already available to us in the format of Schedule 3. With the balance sheet, we are also given notes to accounts for both the companies. Yeah. Okay. Now, we are also required to prepare the balance sheets along with notes to accounts. Okay. Now, in this case, when we are required to prepare the balance sheet, so we need to remember few things. First, we will have to compute the goodwill or the capitalism. We'll have to compute the minority interest. All of those adjustments will automatically come, and all of those will form part of your working notes. So now what I'll do is, I'll prepare the balance sheet and will then move on to all of these workings and the notes to accounts. So currently the balance sheet which I'll prepare, that will be only a format of the balance sheet, because that is how we have to start with. So that's going to be the first thing which will be presented in the solution, and then of course the notes to accounts, and for which we may leave some additional space if required. We'll see as to how we need to move further. So we can say we have consolidated balance sheet of B and A as at the 1st March X1. Yeah. So first we have equity and liabilities. Equity and liabilities. In this case, we'll have shareholders' funds. And amongst the shareholders' funds, we'll have share capital and reserve and surplus. And for all of these, what do we need? Notes. See, note is not a mandate. So there could be certain line items wherein you believe that nothing is available for the preparation of notes. But it's always advisable to have as many notes as possible. That is for further clarity of the reader of the financial statements. So this will be note number 1 and 2. Then we'll definitely have the minority interest, but this is something we'll have to check from the information in the question. So question says that B holds 80%, that's why it will be the case wherein minority interest will also come. So this is minority. maybe I can just put a note number over here. 1, 2, and I can put down the amounts over here. Then the balance sheet in the question contains non-current liabilities, long-term borrowings. So this will continue. Non-current liabilities, long-term borrowings. Note number 4. Then we have current liabilities, just straight away. So we'll have more. Now, please remember that in the exam, you should not write it like this. You should write it properly the way it's given in the study guide. I'm just doing this for the purposes of preserving space for some working. Okay, and then we have the total. Then we move on to the asset side. On assets, we have non-current assets. PPE, non-current investments will go off. Why? Because that is only in subsidiary, so that will not appear. So we'll have only PPE. So you can say note number 6 for PPE. Then in the current assets, we have 3 line items: inventory, trade receivable, cash and pension. Inventory, trade receivable, cash and pension. That will be the total. Okay. Yeah. Okay. As we discussed, now the next thing for us will be to prepare notes. And the notes should be in the order. Means note 1, 2, 3, 4, 5, space, so on, it should come. So that's why, as a next step, what should you do? You should leave space for the notes. Because we have many notes, depending on all of these notes which will be required to be prepared, you should leave some space. Okay? Yeah? Clear? You should leave some space for all of those notes one by one. Clear? Now, before getting on to the notes, I will do some workings. So that will be required. Workings of minority capital reserve, share of holding in the subsidiaries profits, etc. Okay. So I am just straight away jumping onto the working notes. But I am assuming that you have kept some space for notes. We understand that the percentage shareholding of minority is 20. It is already available in the question. Now, since Virat Limited holds Anushka Limited since incorporation, that's why there is nothing which is prior to acquisition. There is everything which has arisen after acquisition. So, is there anything in the nature of capital profits or pre-acquisition profits? No. All of this, in terms of reserves of the subsidiary, will be post-acquisition for the whole. Clear? Clear on this? Now, moving further on to the computation of goodwill or capital. So you can say working note number goodwill or capital reserve. Now, investment of V in A is 3,20,000. So we can say purchase consideration is what? 3,20,000. Yeah. From this, what do we need to reduce? Pre-acquisition profit shares and the share capital for the reserves. So the share capital of A Limited is what? 4 lakh? Yeah, 4 lakh. 4 lakh into 80%. Yes. Equity share capital 4 lakh into 80%. Do we have any pre-acquisition profits? No. Pre-acquisition profits? No. This is 3,20,000. So we have the strange case wherein neither there is goodwill nor there is capital reserve. Correct? Okay. Now, if you go to minority, so what will be the amount of minority interest? Equity share capital will be 4 lakh into 20%, 80,000. And reserves. Will the minority get the share of reserves? The answer is yes. If the reserves are post-acquisition, those will come at the year end. So the reserves of subsidiary are what? 1 lakh. So 20% of those reserves belong to minority. So 20,000. So 1 lakh is the amount of minority. We could have also computed this, or we could also put this working in the notes to accounts. But it's always advisable to do these computations in the working notes instead of notes to accounts. Okay, clear? Clear on this? Now, I think we have checked goodwill or capital reserve. We have also computed minority interest. Now we can go to notes to accounts one by one. And we can just start closing all of those notes to accounts one by one. Correct? Yeah? Okay, so let's go to notes to accounts. And say this is working note. Yeah? So I'll just try to move in the same order because all the adjustments seems to have been made. So note number 1. Share capital. Equity shares if only the holding company will come. 60,000 equity shares of rupees 10 each fully paid up. 60,000 equity shares of rupees 10 each fully paid up. The way it's required to be written in the notes to accounts, you will have to write this properly. You cannot take a shortcut over here. Okay, so this will become 6 lakhs. Now, do we need to mention the share capital of subsidiary? No, but that is already adjusted. Yeah, so this note is over. So we can put this amount in note. Okay. Note number 2. Reserve and surplus. Now, do we have any capital reserve? No. But do we have any other reserve of the holding company? Yes. So, reserve of holding company. What is that reserve of holding company? General reserve of V. That is 1 lakh. That will come over here. and general reserve of A Limited. That is also 1 lakh, but the holding company will not get entire 1 lakh. That will get only 80%. Because 20% out of this has already been picked up by the minority shareholders. So we get 80,000. So this becomes 1,80,000. So this is also done. We can take this number to the balance sheet. We can take this number to the balance sheet. Okay. Third, not the minority interest. For the minority interest, what do we have? 20% share of A Limited. Means net assets of A Limited. 20% share of A Limited's net assets. That was 1 lakh. How did we compute this? We can give the reference of working note number 2. We can give the reference of working note number 2. We have just computed this in a working note and we have given the reference of that working note. Okay, clear? So this is also 1 lakh. So this is also done and we can put this on. This is also done. Yeah, simple, easy to do. Okay. Next is about the long-term borrowings. So I'll just clear all of these notes. Note number 4, long-term borrowings. Now, long-term borrowings do you have for these two companies? Yes. For B and A both, 2 lakh and 1 lakh. Long-term borrowings of B, 2 lakh. Long-term borrowings of A, 1 lakh. So this is B. Do we have any adjustment on this? No. Then we have trade payables. Both of them have trade payables, so 1 lakh each. Note number 5. Trade payable. B, 1 lakh. A, 1 lakh. So this is 2 lakh. So this is 2 lakh. Okay. Yeah. Okay, next. Note number 6. Property, plant and equipment. Here again, you can see that PP of V and A are 4 and 3 lakh. VA 4 lakh. Now it's only an addition. We don't have any adjustments over here. Correct? We don't have any adjustments over here. Then we have inventories of B and A. Note number 7. So I can do that. Note number 7. Inventory. What is the amount? 160 and 2 lakh. This is 3 lakh 60,000. Again, simple addition. Namrata is asking, sir, why are the long-term borrowings not apportioned between Virat and Anushka? Very simple. Minority will pick up the net assets, which has already been done. Okay, so you are considering this to be a net asset? No. If we go by this logic, they should also pick up each and every asset or liability. Yes or no? Which is already done. Their share of net assets is already picked up. Understood? Over here, we are adding each and every on a 100% basis. Each and every item is added on 100% basis. Why? Because this is the approach for consolidation. But because you are picking up 100% of A, if you see this inventory, out of inventories of A, only 80% belongs to majority. But is the majority taking 80%? No, majority is taking entire 100%. That's why what are you doing? You are saying that 20% of this inventory doesn't belong to this group. This belongs to outside the group, and which is appearing in this amount. This amount reflects that entire part of the group, which doesn't belong to the group, which actually belongs to outside the group, means which belongs to minority shareholders. Now understood? Okay. So now we have trade receivables. In trade receivables, we have 80 and 140,000. This will be 2,20,000, then cash and cash. And for cash and cash equivalent, we have 40,000 and 60,000. This one. This becomes 2,20,000. This becomes 1 lakh. So now, can you tell me the totals? Asset side, liability side quickly. And please confirm whether they are matching or not. Quickly. Please confirm whether they are matching or not. Yes, I'm waiting for a response. Okay, great. So I can see totals are matching. Sakshi is saying, so it should be 13,18,000. 15,80,000. 15,80,000. I think same is the response from Anushka, Nishma, and Sanjeev. Very good. So both the sides are matching. Very good. Okay. Yeah. So this was about the preparation of the balance sheet. Yeah, this was about the preparation of the balance sheet. Now, in this balance sheet, you would have seen that except for adjustments related to goodwill or capital reserve, minority interest, share of profits of holding in my opinion subsidiary, there was nothing else. But the balance sheet will not be simple like the one we have done on this. Sometimes there could be certain adjustments in the balance sheet which could be in relation to the transactions which are taking place between the companies. Between the companies means those companies which are within the group. And we need to make the adjustments for them, we need to make the eliminations for them. Yeah, which is also called as intercompany transactions. And let's try to understand about some of those adjustments. So maybe what you can do is you can just start picking up some of these adjustments which are given on page number 10.48. Let's move further. 10.48. Can you go to this page number 10.48? Page number 10.48 of the study material. Now, there are two types of transactions which are possible between the holding and the subsidiary. Two types of transactions means in relation to purchase or sale. It may happen that holding is selling something to subsidiary. This is first set of transaction. Or you can say holding is selling to subsidiary. The other way could be wherein subsidiary is selling to holding. Now, these two have also been defined. If the holding company sells goods to the subsidiary company, this is called as downstream transaction. This is called as downstream. Means going from holding to subsidiary. If the subsidiary sells to holding, this is called as upstream. Means going from subsidiary to holding. Downstream transaction or upstream transaction. Now, we are not limited to only the sale or purchase of goods. As we discussed, any transaction between these group companies will have to be eliminated. Okay, any transactions between these group companies will have to be eliminated at the time of consolidation of the financial statements. Yeah. Now, let's understand how do we eliminate that. If let's suppose holding company sells goods worth of rupees 100 to S at the rate rupees 120. So the cost to H was 100. So cost was 100 to H. But H sold the goods at the price of 120. Okay. Now, S will record 120 as purchases. and H will record 120 as sales. So one company is recording purchase, other company is recording sales. These two will get eliminated. These two will get eliminated. Number one. Okay. Number two. Number two situation could be wherein holding sold goods to the subsidiary and subsidiary has also sold the goods to a third party. Means as at the year end, subsidiary has also sold this to third party. So what will happen? Holding and subsidiary will eliminate their purchases and sales. But there is no inventory held by the group. Why? Because sold outside the group. Group is not holding the inventory, sold outside the group. So group had to make a profit of, let's suppose subsidiary has sold it to third party. Say for 130. Now, if let's suppose H would have sold to third party, H would have made a profit of rupees 30. Now what has done? Now what's been done? Now H made a profit of 20 and S made a profit of 10. So all in all, group made a profit of rupees 30. So that's why in relation to this profit which has been booked in the group, it's perfectly okay. Yeah. But let's suppose inventory in relation to the sale made by H to S is still lying with S. Means S has not been able to sell this inventory. This inventory is still lying with S. So there is no third party which is there right now. This will definitely be sold outside the group. There is no question about it. But as of now, it's not sold. So now we are at year end wherein S is holding inventory of rupees 120. Now there is a problem. Now there is a problem. Let's understand the problem. If we eliminate purchase and sale, that is okay. That is already done. But this inventory, which has a cost of rupees 100, is now appearing in the books of group. I'm not talking about H or S because now I'm talking about the group. This inventory, which should have been recorded at rupees 100. Why? Because its cost price is rupees 100. Is now appearing in the books of group at rupees 120. Is that correct? No. Because this profit markup of rupees 20 doesn't belong to outside the group. This is something which is internally generated, which is not acceptable. Which is not acceptable. So what should we do? This profit or this profit element or this markup which is appearing in the inventory as at the year end needs to be eliminated from the inventory. And how do we eliminate that? We will reverse, or you can say we'll reduce the amount of inventory by reversing this markup. So reduce the amount of inventory by rupees 20. By rupees 20. And who would have booked this profit of rupees 20? It's the parent who would have recorded this profit of rupees 20. So that's why in the consolidated P&L, 20 should also be removed. Yeah, only then this will become contra. Clear? Next. Next, just give me 1 minute. Next is about the upstream transactions. Next is about the upstream transactions. Now let's suppose S had goods worth of rupees 100 sold to H at rupees 120. Now here again, what should be done? Here again, purchases and sales of both the companies should be eliminated by rupees 120. Yeah. Here again, we need to check whether H is holding this inventory or not. If H is not holding this inventory, do we need to make any other adjustment? No. Because this has been sold to third party, whatever profit was required to be booked by the group, that is already done. Problem arises when this inventory is held by H. It may be fully held, it may be partly held, it doesn't matter. We need to understand it conceptually. If this inventory is held by H, here again, what would the group need to do? As at the year end, the group will have to reduce the amount of inventory. Here again, the amount of inventory will have to be reduced by the amount of markup. But in this case, this profit element of rupees 20 was booked by who? S and not H. This profit element was booked by S and not H. So this rupees 20 profit element is appearing in the reserves of S and not H. Correct? So that's why this adjustment of rupees 20 in the reserves of H will be done for both minority as well as majority. Unlike the one we did for H. Why? Because whenever H books the profits, it's fully for H. But whenever S books the profit, it's partly for H and partly for minority. So that's why whenever such a type of situation will arise, we'll have to take care of this aspect. Yeah. And for this, what we can do is we can just quickly move on to this small illustration number 11. Okay. We can move on to this illustration number 11 quickly. Yes, can you move on to illustration number 11? This is page number 10.49. Inventories costing 180 lakhs to be at a price of 200 lakhs. Entire inventory as at the year. Suggest the accounting treatment for above mentioned transactions in the CFS of A Limited, giving the reference of relevant accounting standards. Quickly on to you. Can you answer this quickly? Over to you. I am waiting for a response quickly. For this first part, what will be the answer? Quickly. What will be the adjustment? I am waiting for a response. First of all, you can tell me whether you will consider this as upstream or downstream. And depending on whether it's upstream or downstream, what will be the adjustment required? Yes, quickly, what will be the adjustment required? I'm waiting for a response. Okay, great. So Sushil is saying 160 is the adjustment. 160 means I didn't understand your point. And Sanjay is saying it's downstream. Sushil is saying it's upstream. Okay. Can you tell me the adjustment which will be required? These one or two words I don't think will work. We need to briefly explain now. Quickly, if you can let me know what will be the solution for this. Anushka is saying as per AS21 it should be eliminated. All right. Sanjay is saying 16 lakhs A limited, 4 lakhs minority interest. Okay, great. So let's get on to the solution now. So now it's a case of downstream transaction. Why? It's going from holding to subsidiary. You can just understand it this way. Downstream, going down. So this is something which is downstream. So what are the adjustments which are required? B will book purchases of rupees 20. A would have booked sales of rupees 200. In the consolidated financial statement, first adjustment will be elimination of sales of A and purchases of B equivalent to 2 lakhs. So this will be the first elimination. Clear? Number 2, because the stock is unsold, and because the stock is unsold, so that's why if this transaction would not have taken place, then this stock would have been appearing in the books of group at rupees 180 lakhs. Now this is overstated in the balance sheet of the group. So what should we do? Reduce the amount of inventory by rupees 20 lakhs. And who has booked this profit? A has booked this profit. Holding company. So we need to reduce P&L of holding, that means A, by rupees 20 lakhs. This also needs to be eliminated. Okay, Sanjay, I think, has given the same answer. Very good. Anushka is saying unrealized profits of 20 lakhs would be eliminated from the CFS by reducing consolidated profits and reducing the value of closing inventories. Very good. Yeah, clear on this? Clear on this part? Okay, great. Moving on to the next situation, situation number B. A Limited holds equity share capital and voting power of B. 75%. A Limited purchases inventories costing 150 lakhs from B. So B has sold to A. B has made a sales to A at 200 lakhs. Whose cost was 150 lakhs. Entire inventory remains unsold with A. Now, again, the same question for all of you. Whether this is upstream or downstream, and what will be the adjustments in the consolidated financial statements. Quickly, over to you. What will be the adjustments in the consolidated financial statements? Yes, I am waiting for a response. Yes. Nakul is saying it is downstream. Manish is saying it's upstream. And I think Anushka once again has given a very detailed answer. I'm hoping you are writing it on your own. You are not copy pasting from the study material because that is of no use. I'm hoping you are doing it on your own. Manish is saying 37.5 lakhs will be deducted on A's part and 12.5 lakhs will be deducted on from the minority. Okay, great. So let's understand. Now this is going from subsidiary to holding. So this is upstream. This is upstream. Over here, once again, what are the adjustments? First of all, eliminate purchases of A and sales of B equivalent to 200 lakhs. This needs to be eliminated first. Anushka is saying it's upstream. Very good. Manish is saying upstream. Sanjay is saying it's upstream. And Sanjay has given the same adjustment which Manish has given. Great. Okay, next. Reduce inventory. See, this has to be common because the inventory is currently overstated. Yeah. So reduce inventory by rupees 50 lakhs. This has to be reduced by rupees 50 lakhs, right? Because this should appear in the group's balance sheet at 150. Currently, it's appearing at 200 lakhs. But this 50 lakhs profit has been booked by who? Subsidiary, not the parent. And share of subsidiary goes to two parties. Who? Majority as well as minority. So that's why whenever holding will pick up the share of subsidiaries' profits. So that means A's share of profits of B, which A will pick. This will be reduced by 75% of 50 lakhs. Yeah. Similarly, when the minority will pick up its profit share, this will be reduced by 25% of this 50 lakhs. Yeah. Why is this third and fourth treatment different from the one that you see in case of downstream transaction? Because of the accounting which was done in the standalone financial statements. Clear on this part? Yeah, clear on this? Easy to understand? All of you, easy to understand or not? Yeah. So any questions, any doubts in case you have on this, please let me know. Because we'll now conclude our discussion over here. We are still left with some part of this consolidation in terms of preparation of P&L, in terms of some adjustments related to consistency in accounting policies, and I think bit of in relation to revaluations of accounts. So we have already covered that, but still I think we can practice one more illustration based on that in the next session that we are going to have. Yeah. So that's why once again the homework for you will be to make sure that you revise all these three sessions that we have covered, particularly the one that we have covered. Okay, then you will be able to appreciate it the most. All right, yeah. So this we can just conclude our discussion for today. Thanks to all of you once again for your time and for your wonderful participation. Thanks so much.